Thank you and welcome everybody to Brookings and to this discussion. Our first panel is on the issuers of capital, and we have a very distinguished group. I'm going to give a very quick introduction since you all have the information in front of you. I guess we'll go in alphabetical order. So our first speaker will be Jim Angel. He specializes in the structure and regulation of financial markets. He's visited over 70 financial exchanges around the world, and his current research focuses on financial market structure and regulation. He's an associate professor of finance at the McDonough School of Business at Georgetown University. I'm going to do all three here so that we don't interrupt. We have more of a continuous flow. Our second speaker is David Hirschman, who's been a friend of Brookings for a while. He's president and CEO of the U.S. Chamber of Commerce Center for Capital Markets Competitiveness, the CCMC. He leads the Chamber's initiative dedicated to making U.S. capital markets the most fair, efficient, transparent, and attractive in the world. And then the third person is Hugh Richardson. Hugh is managing director and co-head of investment grade finance at J.P. Morgan. The group has responsibility for J.P. Morgan's global investment grade finance business, including the origination of loans, bonds, and acquisition financing. He's worked at J.P. Morgan in different capacities for 16 years. Okay, thank you very much. Let's start with Jim Angel.
Thank you. Good morning. It is an honor to be here. And I want to start my prepared remarks on the crisis in capital formation that we have in this country. America, we've got a problem. Yeah. You think about the Apollo 13 disaster where they said, Houston, we've got a problem. Well, it turns out our public capital markets are shrinking steadily. Despite the fact that we now have record high stock prices, we have roughly half as many public companies listed on our exchanges as we had back in 1997. The reality is, our public capital markets no longer welcome small companies the way they once did. Here's a graph that shows you the steady decline from nearly 8,000 to under 4,000 public companies listed on our exchanges. Here's a fun trivia question for you. How many of you have heard of the Wilshire 5000 Index? It's an index that basically tries to cover all U.S. common stocks. Not the exchange-traded funds or the foreign stocks that trade here, but basically all U.S. common stocks. There used to be nearly 8,000 constituents in the index. Anybody know what the most recent number is? I see one person smiling there who probably knows. 35, close. Actually, as of March 31st, it's 3,700. So this is symptomatic where the 5,000 are no longer 5,000. Now, you may be wondering, why is this a problem? There are those in this town who would say, oh, little companies like that shouldn't go public anyways. They're risky. Investors might lose money on them. But guess what? The public capital markets provide capital for economic growth. They provide capital for companies to expand, and they provide liquidity opportunities for earlier investors. That's really important because no investor wants a Roach Motel investment. No investor wants an investment where they can get in, but they can't get out. Would you put your money in a bank if you couldn't get your money out? No. So having the opportunity for earlier investors to cash out when they need to is actually a very important part of the capital markets. Well, what happens when we close off the public capital markets for smaller companies? Well, that means smaller companies can't get the capital to grow into bigger ones. It means that, fewer people bidding for smaller companies. That means less rewards for entrepreneurship, less of an incentive to start smaller companies. And this is where our economic growth comes from. It's from the entrepreneurs who start the new companies that provide the economic growth and the jobs. So what this means is by closing off the capital markets for smaller companies, In the long run, what are we going to see? We're going to see, less economic growth, fewer jobs, and in this town, that means less tax revenue. Now, what's going on? What is the cause of this decline? And there are numerous causes. And I only have 10 minutes, not 10 hours, so I can't go into all of them. But there are three big drivers here. For one thing, we've raised the fixed cost of being a public company. That we have this one-size-fits-all mentality in our regulation that if you're a public company, you've got to do all the same things Exxon does. Well, you raise the fixed cost, a lot of companies say, hey, it's not worth it. It's not worth it paying a couple $1 million a year in compliance costs for a company as small as mine. Second major problem, the litigation environment. As one CEO of a non-public company told me, hey, if I go public, I get sued. End of story. And the third area is that of market structure, the technical details of how we organize the market for smaller companies. 25 years ago, we had a very different market structure in the old NASDAQ for smaller companies than the old NYSE. We now have a more one-size-fits-all mentality towards how markets are organized, and we no longer have those differences in structure. Oh, and yes, there are other factors going on. Some people might say the dot-com bubble, that's less than a fourth of the decline. General economic conditions, we've had downs as well as ups. Rise of foreign markets, well, we're not talking about foreign companies not listing here. We're talking about U.S. companies not listing here. And then we get, private equity. What about private equity? Well, it's really not a complete solution. I see the rise of private equity as a reaction to the closing of our small cap markets, not the cause. Private equity is more expensive than public equity. And when you think about it, if the only people who are bidding for small companies are the private equity, and you take away the bidder of the public markets, that means they're going to be paying less for those smaller companies. And furthermore, private equity is not available to most retail investors, either through individual stocks or through the mutual funds that most retail investors invest through. Well, some people might say, well, wait a minute, didn't Congress fix this a couple of years ago with the Jobs Act? Well, they tried. It was well-meaning, but when you look at the details of the Jobs Act, most of what it did was it made it easier for companies not to go public. They relaxed, I hope I'm not getting too far into the weeds here, they relaxed rules on private offerings. They increased the threshold at which you're actually required to file financial statements with the SEC. They gave a statutory mandate for crowdfunding, but they weighed it down with so many regulations that it hasn't gotten off the ground. And yes, they do give an exemption for some regulatory requirements for smaller emerging growth companies, but they put a 5-year limit on it. Now, so where we're headed in this country is towards two-tier capital markets, where we have the public markets, and then we have the private markets, the so-called 144A markets, the accredited investor markets, the A+ markets, in which basically a fairly low degree of liquidity. So what's going to happen is the well-connected friends of the better private equity firms get all the good deals, the Facebooks, the Ubers, etc. The mutual funds that the general public invests in, we don't have access to those. The public markets and the public investors get the exhaust from all of these deals. So the result is the general public gets mediocre returns. And what that means, if you're about inequality, increasing inequality in this country. So, to summarize, we've got a problem here. There's a crisis in capital formation that threatens U.S. economic growth. Now, what's the solution here? Again, only have 10 minutes, not 10 hours. We basically need to rethink the public market for small cap firms. The one-size-fits-all mentality of our regulatory system does not work. We need litigation reform. We need to make sure that we reduce the cost and the risk of litigation. I'm not against litigation, but we need to reduce the cost. We need a fair dispute resolution system that is not nearly as risky and expensive as we have now. We need to right-size the regulatory burdens for smaller companies. We should not take a nanny state of view and say, no, little companies should not go public because investors might lose money. No. We need to make sure that the regulatory burdens are appropriate to the size of the company. So, things like conflict minerals, Sarbanes-Oxley, other very expensive mandates probably should not apply to very small companies. And we also need a regulatory attitude of diversity in market structure, an idea that we allow different types of markets for smaller companies. One size does not fit all. And with that, I will turn it back over to our host and the next speaker. Thank you.
So our next speaker.
Well, thanks to Brookings and thanks to Martin and Doug. I think the leadership you have provided here and are providing on these full range of issues really is not just important, it's urgent. So much of the conversation around financial regulation tends to be a bit of a shouting match about, with two extremes, repeal versus don't change at all. I think and it's almost understandable in a way that the debate over the last 5 years has been focused entirely on systemic stability with that kind of a conversation. But really, one of the most challenging things for us, from our perspective, is that so many of the fundamental questions around how best to organize our capital markets, how best to incentivize capital formation, have not yet been answered, even fully debated, and yet we're busy implementing solutions without a way to measure whether we're making it the overall system better and whether this will all work. So I think the leadership that Brookings is providing, that Doug and Martin specifically are providing, is very important. If we can expand the thoughtful conversation, we may not get it all right, but I'm sure we will make our capital markets healthier. So thank you for including me. If I had to simplify my message, is that we all benefit from systemic stability, and we should do everything we can to prevent the next crisis, ensure we have a stable system, and that our capital markets are robust, liquid, transparent, and well-regulated. But we also need growth. And we don't believe those are binary choices where you pick a little of one or the other. We think there's a way to achieve both. And what we put a lot of thought into is how you do that. I like to refer to our system, if maybe using a different, same description, but maybe different terminology. What has made this country great is that more than any other country on earth, we have had what I like to call the Baskin-Robbins of flavors of capital. Now, for those of you who don't know the history of Baskin-Robbins, there was a time when, even though you might know the 31 flavors sign on the door, and 31 is certainly enough when you go in, especially since most people buy chocolate, vanilla, and strawberry. But what gets you in the door is the 31, right? Well, it turns out the dirty little secret about Baskin-Robbins is that when they were in deep financial trouble a few years ago, the real asset, what remained, what actually created valuation for that company, was not the 31 flavors, but the fact that they have over 3,000 recipes for different flavors of ice cream. So maybe 31 at the store you go to when you go, but it's really the breadth. And the same is true with our sources of capital. It's the diversity of our system, the fact that every kind of business at every stage in development can access capital in an ecosystem that's all tied to our public capital markets is what's important. So let me give you 3 examples just to give you a way to think of this. I like to think of the lawn service, maybe because I'm too lazy, although I probably should mow my own lawn. But think of what it takes to start and run a small lawn service. You probably don't think of the capital market, certainly as described today, when you think of the lawn service. But the guy or gal who starts that business needs to buy some equipment, probably needs to buy the gas for their truck and certainly for the lawnmower. May even need to put some cash up front to buy the mulch in the spring, and that person is at the mercy of when I pay the bill. And I pay my bills relatively on time, but certainly there's a period there between when that service is provided and when I get the cash. How does that business manage that? Well, it turns out for most small businesses, and lawn service is certainly the only example, accessing their personal lines of credit, their personal is the way they do that. Now, it'd be great if our country could exist on the rich uncle way of starting small businesses. Unfortunately, most of America doesn't have a rich uncle that can help them start a small business, so we need those markets to work. We need both the 40% that is the personal wealth and ability to access through credit card and home equity loans money to start business, as well as the other 60%. So example number one. Example number two, now let's take a mid-sized business, right? A mid-sized business maybe doesn't need to issue a lot of debt, but they certainly need loans, and they certainly need other ways of accessing the capital markets. And I can tell you, I've been to 3 regional banks recently, all of whom told me some version of they were thinking of getting out of the commercial lending business, either altogether or selectively. That has implications. Nobody's going to put out a press release when they do this, right? No institution is going to, and some of it will be substituted outside the banking system. We already have a very healthy non-banking system. It's 80% of our market, but not all of it will, and certainly not as efficiently and as low cost as the alternative. So that maybe one bank was saying, well, maybe we'll just keep the customers with whom we have the entire banking relationship, and those that we do just loans just simply aren't profitable and aren't likely to ever be profitable again for us, so we won't do that business. Well, the problem if you're a mid-sized business is when you then go to get a loan or to find some additional capital, your choices are pretty reduced to the one institution you do business with rather than having a full choice. Let me give you a third example, and this is now a larger manufacturer, a global manufacturer. This is a real example, and I remember the CFO told me, look, it was Thanksgiving week, and we got a major order for equipment out of Southeast Asia, and we needed to issue some debt in order to be able to begin quickly to make that. They pride themselves in just-in-time manufacturing, and so they needed to be able to get the raw materials and begin the process and deliver on the schedule. But that customer wasn't going to pay until delivery. So we issued a bunch of debt on the Friday after Thanksgiving. And I liked the fact that I had a number of choices of where I could do that. And furthermore, that I knew that the institution I was dealing with might not be able to place all of it that day in the markets, but might be willing to hold 20% of it. Say if it's a $400 million issuance, maybe they find willing customers on the Friday after Thanksgiving for 300, but 100 they keep over the weekend. Things like the Volcker rule make it really hard and really difficult to understand from a regulatory perspective whether you can do that. So again, going back to my Baskin-Robbins flavor, it's really the diversity of that ecosystem, and it's all interrelated. So what do companies need? They need choices. We've done multiple surveys of companies of all sizes, and what they tell us is they want choice. They want a variety they want to be able to find the most, and I think the description was given was right on, and your list of what they need was the spot-on list. They want the efficient, low-cost, ease of transaction choices. And they want clear rules of the road. They want to make sure, they want to know that in managing their financial risks, they're not creating risk to the non-financial company. And so much of what we've done is really to make it harder for non-financials to manage all those financial needs. Commercial paper is a good example. Not every company issues commercial paper, but for those companies that are significant issuers of commercial paper, money market mutual fund rules are going to have a significant impact on that ability. And what when we talk to regulators about that, it's not that they didn't understand it, they didn't know the importance of the commercial paper market, or didn't understand that in the future, as the economy grows, the commercial paper market could be even more important. The point is, aren't your members happy that we're making the systems more stable? And yes, it'll be much more expensive to finance yourself in the short term, but the benefit of that, we won't have another crisis like the one we just went through. That's a fair debate, but we should be having that debate. And if we keep answering the question every time, stability over commercial paper, I think we're going to get it wrong, and we will jeopardize that ecosystem. We'll make it harder for companies to manage risk, to manage liquidity, to access credit, to raise capital, and to otherwise access every flavor of what they need from the market. So one of the things that worries us is there's nobody in charge of looking at the cumulative impact of this and looking at all the collateral implications and making sure that we achieve those dual goals. We do a stress test on the banks, and we do lots to check the stability of individual institutions, but we do very little to assess the entire system. And Dodd-Frank really doesn't have a way to do that. So let me end with just 4 things, and we can talk about it more in the panel, that I believe are the biggest regulatory threats here, the biggest issues that we should think about. Again, it's not any one single rule. It's the totality. It's all the things that were done out of the Basel suite of rules are in concept good things. We believe in more capital. We believe in greater liquidity. But the combination of them are discouraging people from staying in markets. We cannot have one size fits all when it comes to systemic risk management. That's a term that maybe we overuse a little bit, but I think it's right. We have to look at how our consumer protection efforts impact the ability of small business to access credit, going back to my example from the lawn service. And we need to make sure that we don't use enforcement as an alternative to sound regulation. That when it comes to enforcement, everybody's for a level playing field and tough but fair enforcement. And all too often, the litigation environment and the enforcement environment creates another level of jeopardy, increasingly where institutions are lending to the test or lending to what regulators might perceive down the road rather than navigating in clear rules. So thank you very much, and I look forward to our conversation.
Good morning, everyone. And again, thank you for the invitation to come and speak today. I hate to disappoint people, but I have to take a small detour through the bank market. So sorry about that, but as you heard at the beginning from Martin, the interplay of bank capital and capital markets is absolutely critical in terms of how my issuers, which are basically non-financial corporations globally, think about their access to liquidity. So I want to just take a little bit of a moment to talk about what's going on with banks right now. And the first observation I'd make is that it is extraordinarily hard to generalize. The phrase that you're going to hear more and more and more around banking is multiple binding constraints. This is the new trendy phrase that is being used a lot in terms of how banks are trying to navigate the new environment. And these multiple binding constraints that have been imposed are different for everyone. Individual banks are finding that they are bound by a different constraint, depending on where they are globally, regionally, or how big they are in a particular region. And so one bank may be bound by CCAR, one bank might be bound by GSIB. It all depends on individual's perspective. But the one thing we can say today is that currently the bank market in the US is extraordinarily healthy. When I think about what my treasurers need banks for, they need them for their daily liquidity. And we have a very well-functioning daily liquidity market of people's revolving credit facilities at the corporate level that are being rolled over with no issues for multiple years. Yes, there are exits. But for every exit where a European bank or a US bank may reduce, there are 4 non-US banks willing to come in and take their place. And then the second part where my treasurers need liquidity is for large strategic M&A transactions. They need $10 billion to go and buy another company. They need $50 billion to go and buy, Verizon needs $50 billion to go and buy Vodafone. The availability of that capital globally is extremely healthy. Probably more so than the daily liquidity market that we talked about before. So as we see the market today, and I would stress today, currently, the bank market is in good shape. Where are we seeing some dislocations, which again is where we look for the capital markets to provide some solutions. The first area I would say is highly leveraged transactions. There's been a lot of focus on the origination and distribution into the market of higher risk transactions, leveraged buyouts, and other highly leveraged corporate credits. It's still unclear as to where that's going to go. Are there going to be new intermediaries that are going to step in and take advantage of that? And are there some unintended consequences of this in terms of where you have a company that is under some financial distress, but it's not totally distressed? Are you able to step in as a bank before complete distress? Or do you have to wait And some of these things are beginning to sort of trying to resolve themselves. I think we'll see some changes there. There are also some parts of the bank of lending that don't fit banks anymore, just fundamentally. One of those you'll be hearing a lot about is infrastructure. There's a constant drumbeat in the paper of infrastructure. Who's going to finance it globally? Those assets, or those debt assets to finance those projects, don't really belong on bank balance sheets anymore. For capital rules, for liquidity rules, the ability to lend for 10, 15, 20 years to a construction project is something that just is economically extremely unattractive for a bank. We'll be looking for other capital markets providers to step in there. And then there's a third part of the market where banks are struggling, which is where regulation has been specifically targeted to size or systemic issues. So, for example, if you are asked by a client who is a financial institution located outside of the United States and rated below investment grade, that is the trifecta of horror for a bank lending officer right now. The amount of capital, the amount of liquidity that you have to hold against that makes it almost impossible for you to do that. So again, we're definitely seeing sort of certain areas of distress, or not distress, but complications that are going to have to be resolved over a period of time, but generally taken very, very healthily. I would stress Doug's very important point at the beginning, having worked both in Europe and in the US, we still look globally, and we look at the fact that the non-financial corporations still have way too much bank debt outside of the United States. We use the number in Europe of somewhere in the region of 50% of corporate financing liquidity is still provided by bank markets. We compare that to the US at around about 20%. In some regions within Europe, that's the Euro market as a whole, if you take Spain, Italy, other places, that number is well above 50%. And at some point, there will have to be some transition of that debt from the bank market into the public capital markets. I would say that there's been a huge move in that direction. If you look at the growth of the European high yield market over the past 5 years, it has increased exponentially. If you look at the breadth and depth of the Eurobond markets has increased exponentially. And also, we'll talk about this in a little bit in more depth, the increasing number of non-US clients that are accessing pools of US capital. I was going to spend a little bit of time transitioning from the bank market to the public markets via the private placement market, but we have one of the most influential private placement investors sort of in the room, Robert, who represents the Prudential, who are one of the largest players in this market. But I want to bring this up, and I'm sure he'll elaborate on it later, but this is a pretty unique capital market. You're on the public side? Okay, perfect. And I do want to bring this up because it is somewhat the envy of a lot of other people in the world as they look at our capital markets. When I talk about the private placement market, it's the market where corporations execute long-term financing directly with insurance companies, where banks act as agent rather than underwriter, and it's about outstanding about $300 billion of capital in the U.S. market today, issues about $50+ billion a year. Again, a great source of capital because the insurance companies are willing to transact with smaller companies. They're willing to trade their credit expertise for a premium price for a security that doesn't trade as liquidly. And when I talk to a lot of people around the world that are trying to develop new markets in the UK, why can't we have something like the US private placement market for UK corporations? They look to that as a lending model for companies that are transitioning from the bank market, but not yet big enough to access the global capital markets. So we could answer more questions as people are interested in that. But let's turn to the public markets for a moment. And again, I want to reiterate Doug's point. We have the most outstanding liquid market in this country. He mentioned the numbers outstanding, 8 trillion outstanding, 1.5 trillion issued every year, about $20 to $25 billion changes hands every day in the corporate bond market. And that liquidity has expanded globally. The euro markets are much more liquid than they were before. And now we have a raft of ancillary regional markets, the sterling market, the Swiss franc market, the Canadian dollar market, the Australian dollar market, all offering fairly good, not as like the US, but good global liquidity to people. What does that mean for some of our corporate treasurers? If we think about the US market, 2 years ago, we raised $50 billion in 2 days for Verizon from public market investors. 2 days. 2 weeks ago, we raised $17.5 billion for AT&T in about 5 hours. Yesterday, we raised $10 billion for Oracle. These numbers are becoming like quicker and easier for everyone to actually digest. The concept of a $50 billion bond transaction 10 years ago would have been unfathomable. Definitely, there's an impact of what the central banks have done around the world in terms of flooding the market with liquidity. I'm just looking at my timer here, not checking my email. But I think we're looking at unprecedented access, unprecedented liquidity in the market. James, I think it was raised a very important point. This is not accessible to everyone. The cost of this is incredibly expensive. Ratings, documentation, SEC registration, and then what makes our market great is the amount of diligence and the amount of legal process that goes into underwriting these securities. Protection for investors. The cost of diligence, the cost of having an attorney provide you with a 10b5 opinion on your disclosure. All those things that have made the market so great, so transparent, so healthy, also have raised costs to this market and make it somewhat expensive. So I'm going to spend my last minute here talking about what's wrong with our market, because there's a lot of stuff when you open the paper, you're going to think that what's he talking about? All I read about is the crisis in the corporate bond market. And what it really revolves around is liquidity in the secondary market. And this one statistic that everyone holds on to, which is dealer positions have decreased. James and Doug mentioned investors want transparency. They want transparency in secondary markets. Secondary markets are broken because banks have to hold too much capital. They'll have to hold more capital now. They can't trade as many bonds. A couple of observations from my perspective. I'll be interested on the perspective of the investor community on this. But let's face it, any market where everyone is leaning one way is going to be untidy when it unwinds. And we all know there's a global bull market in credit right now. That will reverse at some point. Right now, markets are very illiquid and they're in great shape. Why are they illiquid? Well, because I'm very unwilling to sell bonds to anyone right now because I know I can't buy them back. So that situation may well be reversed on the other side. The other point I want to bring up is this market has never been particularly liquid anyway. We have one big problem. We have, if you trade equity, if you trade JP Morgan equity, there is one JP Morgan security. There is one IBM security. At last count, JP Morgan had something like 6,500 securities in the fixed income market. We have a heterogeneous market versus a homogeneous market, which we have in equity, which again makes it inherently illiquid. Where should we be concerned? And I'll end on this point because I've run out of time. Where we should be concerned is there's one part of the market which we're struggling in terms of how we're going to resolve this. Credit and fixed income was designed for long-term buy and hold investors who may need liquidity at some point. But if they can't get the liquidity at that second, they may be able to wait a day. They may be able to wait 2 days. One of the big issues that we're concerned about right now is the growth in funds that have guaranteed daily liquidity to their holders, and they hold fixed income securities. When it comes time for those investors to have to liquidate, because their investors are demanding daily liquidity, how is the market going to react to providing that liquidity in instruments that were not necessarily designed to have to operate that way? And I think we'll spend a lot of time, so we'll see a lot of that dialogue playing out over the next couple of years in terms of how do ETFs and high yield and corporate bonds, how are they going to resolve themselves in a more difficult environment? I think I'll end there because I think I'm out of time. Thanks so much.
So we're going to come up and all come up on the panel. There's microphones here. This is just a minute to get settled in. Okay, testing. Are we on? Yes, excellent. Thank you. Thank you all for terrific presentations, and I think we have quite a bit to talk about. Jim, I'm going to start with you. You were the first speaker. You presented a rather gloomy view of capital markets, and in particular, the sort of inequality that was occurring in capital markets. Hard for small companies to participate in the capital markets, hard for small investors to get the kind of returns that larger investors, PE investors can get. Now, let me ask you one specific question. You mentioned that small companies are having trouble going public. Now, one suggestion about that, and that's reflected in the fact that we don't see as many startups, we don't see as many companies going public. One explanation I've heard for that is that we now have a different business model. So a small company will start, grow a little bit, and then when it reaches a certain size, it's bought out by a Microsoft or a Google or somebody else. And so that really we have a changed way of smaller companies growing. Do you think that's what's going on, or it doesn't sound like it, but...
Well, I think that's partly a reaction rather than a cause of the drop in number of public listings. If it's no longer feasible to go public because of the cost, because of the burdens, well, when it's time to liquidate, who do you sell to? Well, in that case, it's you sell out to another large corporation like a Google or a Microsoft. And of course, this brings up all kinds of issues about concentration, about the size of corporations. So I think there are a lot of public policy issues there as well.
Just add something on that.
Please do.
Look, I think, again, the answer is you need both, right? For many companies, even those that choose to be acquired or not go public, having that public option increases their valuation. So even if the right answer is to be acquired by somebody else. It's also true if you look back through our history that the companies that have really made the giant leapfrogs have usually done so by accessing the public markets. It's very difficult to go into another company and get the level of tension and investment to really take you to that next level. That's why you see so many of the biotech companies going public, even if their end goal is to be acquired by a larger pharmaceutical company.
Okay. Well, just for the sake of argument, though, if you look at some of these small companies that get bought by a Facebook or a Google, I mean, it seems like they're a few years old and they get sold for about $5 billion. So is it really true they're not getting a high enough price or is these the exceptions rather than the rule?
Yeah, I think in some cases it's the exception, but even if you get an extraordinary valuation when you first sell, it's not that the issue that we should think of in the long term is for the broader economy investors is will you get the follow-on investment with, will Facebook then, and they probably will, so not to pick on Facebook, but will there be the investment to build that out to the next level?
Right, and I think the very important thing is when you have only a small number of potential bidders, if the only people who can take you out are Google and Microsoft, they're going to be willing to pay less than if there are additional bidders. So having the public market as an option increases the expected returns even to people who eventually sell out to private investors.
Okay, so what would you guys, I'm going to come back to you in a second, Hugh, but what would you guys like to see? What's the key thing that's holding back this process or making the two-tier capital markets or the regulation that's standing in the way of greater growth or greater small business? What's the most important or the couple of most important things that could change?
The team I run at the Chamber was created because we saw the need to study this post-Sarbanes-Oxley pre-crisis. And what we discovered at the time was that it's really easy to oversimplify and to say it's one thing or two things or three things. Maybe we can come up with, and I think Jim did a nice job. I think Jim did a nice job kind of listing some of the higher order things, our litigation environment. But really it's a variety of, it's good to summarize it as the overall costs of being public. But when you break it down, there's lots of them, right? It's the role of you could have a whole conference, I hope Brookings will, just on what drives that decision making.
Right.
I would say the most important thing is a change in attitude. That we have to understand.
That's tough to do, though. How are you going to do that?
Well, by having conferences and by getting the message out that we've got a problem here. That it isn't just, companies are getting bigger. It's like, these smaller companies are the canaries in the coal mine, and those canaries are basically not there. That is a symptom that the atmosphere in the coal mine is turning toxic. And I think the first step is understanding, admitting we got a problem here. And then we realize, there's a whole confluence of things that have come together to cause this toxic situation. And we need to address all of them. We need to understand that new companies really are our future. That's what we do well, and that's what we have done well in this country. It's what we need to continue to do well. And then we need to say, okay, how can we facilitate them getting capital, not just public capital, but private capital as well? And we need to realize that the regulatory and legal environment that is appropriate for a $1 trillion company is not appropriate for a $1 million company. So we need to understand that one size does not fit all. We need to stay away from the temptation to load more and more burdens on public companies, but not private companies. So there are a number of things we can do, but the very first step is to understand that we've got a problem here.
Well, I would say, having asked you a couple of questions, I am sympathetic. I'm on the board of a small company, and our compliance costs are very large relative to the size of the company. So I think that is something clearly I would point to as needing to be adjusted. Let me come to you, though, Hugh. You painted a much more positive view of capital markets. Obviously, you talked a lot about the bank lending and the role of banks like J.P. Morgan. But do you have a response to what's going on? Do you agree that this difficulty of access to capital for small companies is a really pressing problem? Is that something that J.P. Morgans of the world are doing something about?
Well, I think from my perspective, I'm fortunate that most of my client base resides in sort of the mega cap multinational companies who have their own challenges, but they do have a lot of competition for their business, whether it's from banks or whether it's from investors globally. I come back to this competition point on we're talking about the IPO path versus public equity market path versus do you sell yourself to a Google? One of the things that we're seeing introduced more and more into our market as fund flows have increased globally is once upon a time, if you were a U.S. company and you had a captive investor base of 4 or 5, well, that's a slight exaggeration, but maybe call it 5 to 15 major U.S. companies. Now, when you run a debt auction for a U.S. company, you have Japanese life insurance investors trying to get involved. You have European asset managers trying to get involved. And I think the focus of my clients is actually how do you develop more competition for what people are viewing as an incredibly scarce asset. And I think it's somewhat different as you move down the company size where things are getting more complicated. I do think one thing that I have seen, which I think is very encouraging, is the rise of, or the ability of, for lack of a better word, intermediaries to fund themselves in the capital markets. And I think the BDCs, for example, are a fantastic example of this, where we, as a high-grade person who runs an investment-grade business, I didn't know what a BDC was. We're now raising billions of dollars for BDCs from public market investors who are then using those funds plus their equity to lend on to smaller companies.
Make sure everyone knows what a BDC is.
BDC, business development company. So that, again, what is encouraging for me is to see people take advantage of the liquidity that is on offer to be able to create other liquidity pools for companies that can't access that directly.
You mentioned the private placement market, which I'm somewhat familiar with and have been struck by, which you say is quite large, $300 billion, which is not trillions, but is relatively large. Why is it so hard for other people to get started, and are there reasons why it couldn't expand more in the U.S.?
Part of it is I think we've just had historically a long history of having developed it, and it's a time and labor intensive business. It's very much like running a bank portfolio in terms of it's highly credit intensive. You can't necessarily rely on a lot of public market information. You have to assign a team of credit analysts to actually work and do the credit analysis as you would with a bank credit officer. So the infrastructure costs are high. I think what's interesting though, and I'm sure others on the investor side have better opportunities, is a lot of these companies are now looking to take on and start managing third-party assets in this type of investment. So if I'm a European money manager or European insurance company, I don't have a team of 50, 60 credit analysts. I have 3. How could I get involved? Well, one of the ways I can try and get involved is by outsourcing some of this money to someone who does have that expertise, and I think that's something that we're certainly seeing globally.
Now, some people, I'm going to come back to you in just a second. Let me ask you one more question, and that is on this lack of liquidity in secondary markets, which a lot of people have talked about, and Goldman Sachs has written some statistical analyses saying this is raising the cost of capital for small business. But you didn't seem to feel it was that you felt this was sort of being overplayed in some way, or maybe I misunderstood.
No, it is we've had a one-way market in credit globally for the past, well, since 2007 essentially, give or take a few speed bumps. And we've had a largely supportive macro environment, right? Securities have been removed from the market by the central banks. They've created a scarcity of supply. They've created a massive demand for yield by pushing interest rates almost too negative in certain parts of the world. So yes, there's a macro and a supportive environment for what's happened. So we haven't seen any of this illiquidity. Everyone is obsessed with what is going to happen when the exit happens, which everyone thinks it has to at some point. And the big argument is just all around is dealers, investment banks, dealers, the dealer community no longer has the capital ability to act as a buffer, to act as an intermediary in that. That's essentially the simple argument that everyone has, which I don't think is wrong. How it plays out, I think is to be seen. I think, though, the good thing in the markets in which I operate in is that there is a natural buyer for these instruments. It's not as though we're going to go into this black hole where all of a sudden something is going to be worth 100 one day and then it's going to be worth 20 the next. There are plenty of intermediaries that will step in that process, the natural buyers of these securities, life insurance companies, pension funds. Yes, there'll be a price. When people sell, prices go down. That is the fact of life. The question is how quickly they do, and in fixed income, there is actually the ability of more intermediaries to step in and take advantage of, view that as an opportunity rather than an impediment to doing more business.
David, you had a comment maybe on this or on something earlier.
I think Hugh's points. I just want to emphasize. I remember talking to a CFO of a Fortune 50 company and said, "Look, I'm going to get banked. I'm not worried about me. Right? But there's going to be a way." But I worry about the guys half my size or the future me. So it's important. And even the BDC example is a good example. That's been an important growth area, right? And it shows you how nimble, how much of the positives of our 31 flavors of capital system are still working. But I can tell you of an example of a couple of those BDC firms that needed more investment to meet the demand on the BDC space, went public and discovered that because our rules are antiquated, they couldn't get liquidity in their stock because it turns out that indexes can't invest in companies that are BDCs. And the regulatory answer was, well, we can't fix that. It's too toxic an environment to make any regulatory changes. And so it really has impeded the growth even in that space. So all of these dots are interconnected. And we need a regulatory system that encourages innovation, encourages new ways to get capital in the hands of capital. And we simply don't have that today because regulators are afraid of looking weak or being accused of looking weak.
What about crowdsourcing? Somebody mentioned the Jobs Act and whether it's working or not working. To what extent is the new big data analyses and crowdsourcing, are they going to solve some of this problem? For example, companies like Lending Club are arbitraging a little bit some of the high rates that consumers pay for credit card debt. Are we going to see more of that? And do you see this as a solution or as increasing more dangers in providing capital for small companies?
I see it as adding another flavor to the sources of capital available. Exactly. That I don't see it as a panacea, but we need to make sure that our regulatory systems appreciate the possibilities here. And unfortunately, our regulators have very skewed incentives. That if they block an innovation, very few people notice. But if they let something through and 5 years later a problem emerges, everybody looks at the regulator and say, why didn't you catch this? So regulators are naturally very risk averse. And I can't blame them for that. I'd be very risk averse if I were in their shoes too. So what we need to do is make sure that we restructure the regulatory system and rethink it, which is badly antiquated. That that is an area where I think we need structural
reform. Is it badly antiquated, or it's become more difficult? Is it the legacy of the past we've got, or is it Dodd-Frank that's caused the problem?
Little of both. But the problem with Dodd-Frank is they didn't use the opportunity to do a systematic and thorough rethink of our fragmented regulatory structure. We have hundreds of different financial regulatory agencies at the state and federal level, and they don't always play nicely together. That our regulatory system was fundamentally designed in the Great Depression, and at that time, the decision was made to have an intentionally fragmented financial system. That really didn't make long-run economic sense. It may have made sense in 1933, but in this century, financial services are too broad to really have a fragmented system. Okay, well, Congress has gradually let go of that fragmentation, but they never dealt with the fragmentation of the regulatory agencies. To have a different agency for commodities versus securities, for example, is just absurd.
Dodd-Frank said, let's make these regulators stronger, more independent, give them more authority, and then we're wondering why it's hard to make them collaborate and work together and come up with common solutions. That's some of the challenges we know we're going to face in implementation of the Volcker Rule. For 5 regulators with very fundamentally different approaches to how to implement it.
Well, Chris Dodd did try in his first draft of consolidating regulatory agencies, but that didn't go down too well. Paul Volcker, the Volcker Alliance, has just proposed a more consolidated structure. Going to be a tough sell, I think, in this or any perspective. Who knows after the next presidential election? But it's going to be a tough sled. Now, there's a view here that's sort of a lot of which is that regulation is the problem. But I want to ask the audience for questions, and I suspect we may get some slightly different perspectives. So let's get some audience questions. Yes. Please identify yourself and a fairly brief question.
Ken Dillon, Sansa Press for Dr. Angel.
Hello.
Yes, for Dr. Angel. Could you please give us an example of a measure that would make being a private company less attractive?
So the question is, can I give an example of a measure that would make being a private company less attractive? Well, it is sort of a level of relative attractiveness. And let me jump on one of my favorite examples, which is conflict minerals. Nobody disagrees that there are horrible human rights abuses that have occurred in the Congo. So some very well-meaning people have said, why don't we make public companies tell us about their use of conflict minerals? I mean, why not shine some light on this? Okay, makes sense. But do you really know where the rare minerals that are inside your cell phone come from? So at what level do you have to go through your entire supply chain to figure out where everything came from? But this only applies to public companies. So if you're a private company doing business in the dark, with all kinds of nasty people, you're totally unaffected by that. But if you are a little public company trying your best to comply with the laws, you have a very expensive mandate. So the relative balance of do you want to be private or do you want to be public, regulations like that only apply to public companies.
So what should you do? Should you tell public companies you don't have to worry about this, or should we tell private companies we do have to worry about it?
Well, that is a good debate.
That's not the one you want to...
Right. I don't want to get into that one, but whatever should be done equally across both. And you can get into the argument as to whether it makes sense at all and whether that disclosure is doing any good.
We should certainly start by looking at whether the provisions we're putting on public companies produce the desired impact, right? The Washington Post found that, in fact, the easiest way to comply with that rule was to stop buying conflict minerals from the entire region, which actually caused more people to go into the militias and actually produce the opposite of the desirable effect. So, if something is good enough that it meets the cost-benefit test, then you might apply it across the entire economy. But you start by making sure that it's achieving the purpose. And in Dr. Angel's example, it's questionable whether that achieved any useful purpose.
Did you want to add to this, or shall we go?
I'm not touching conflict.
You're not touching conflict minerals.
So to give you a short
You're
answer,
a public company, and you're not going to do it.
so to give you a short answer, taking away some of the useless burdens on public companies will make it more attractive to be a public company and less attractive to be a private company.
Okay, I agree with that. We should not get into conflict minerals. Kathy, did you were okay? So there's a question there.
Sorry, she gave me the mic if I could. Matthew McGuire, and I want to ask rather a simplistic macro question, which is, as Hugh mentions, we're in a very odd situation where Switzerland is issuing negative yield bonds. A lot of the euro sovereign debt is trading at negative yields and so on. So it's rather bizarre. I'm just wondering how much of the issues that you raise go away when rates go up. So if borrowing costs increase, does that incentivize more small companies not to use the debt markets and to go public? Does that incentivize some of the regional banks to get back in commercial lending in a bigger way? How much of this that you're talking about is really just about this rather odd situation where money is essentially free?
Do you want to?
Yeah, I think the one thing I would say, and I'll talk maybe a little bit about bank lending. I mean, one of the things that we're wrestling with is fundamentally, our balance sheet is our cost of goods sold, right? And our cost of goods sold has gone up dramatically. Because of the environment that we're in right now, we have not been able, the market has not been able to adjust its revenue line or its cost, or to maintain margin, right? So there's definitely that aspect. I think the issue that we're going to deal with to a certain degree is, can you increase the pricing of your product in response to macro changes? Will you be able to cover your cost of goods sold, right? Because just what has fundamentally changed is that, yes, you have this macro environment in the positive macro environment for everyone in the back. You've got this increasing regulatory burden that's pushed everyone's cost up, balance sheet cost, et cetera. And I think that is sort of to be determined whether you're going to be able to, as you said, adjust pricing to get back into the business, or is the business so fundamentally changed that no interest rate increase will make it attractive again.
Okay, we can have, I think, one more question. Why don't you back there?
Hi, Michael Kirsch, U.S. Econ Solutions. My question's directed to David Hirschman. Your description of the current environment for small business access to banks was reflected yesterday by Senator Shelby at an event saying similar remarks. Really sounds a lot like the 1930s, where there was too much regulation on banks and they weren't able to lend to small business. How do you see changes in the structure of the banking system? In the 30s, it was the Fed discount window. Which changes to the structure of the banking system to make it more easy for banks to lend for working capital loans to small business would you recommend? You mentioned commercial paper, over-regulation on that, but I'd like to expand more on how you think that capital formation could be made available for small business.
Okay, David?
So there's a study out yesterday by the Goldman Sachs Institute that they called the two-speed economy, in which they found that relative to prior economic recoveries, there are 600,000 fewer small business startups in this recovery than prior recoveries. It's the first economic recovery where small business has really not led the way. And there are many factors going into that, but regulation plays a role. So it's it's everything from securitization of credit card debt to the fact that the cumulative impact of the suite of Basel rules is making it harder for retail banking generally, and therefore for that presence to be there. Community banks and mid-sized banks that traditionally have been significant players in this space have face a disproportionate burden on the compliance side. Not that it's easy for larger banks to absorb that. So there's no one simple answer, but I think we need to, what we're trying to do is at least start a conversation that says, let's look at whether we've right-sized these rules in a way that achieves both systemic stability and enables economic growth.
Any last comments? Yes. Fairly brief, if you would.
Well, I would like to add, one last plug for public capital markets, in that when you talk about systemic risk, which is something we haven't discussed yet this morning, The capital markets provide a means to connect the suppliers of capital almost directly with the users of capital. And the advantage of that is you can bypass highly leveraged intermediaries in between. Because when you look at financial crises, when you look at systemic risk, standing there at the scene of every crime is a highly leveraged financial institution. With properly functioning capital markets, where we can connect the users directly with the suppliers of capital.
We thought securitization of mortgages was going to do that, though. So well, I think we need to have some steps along the way, but I'm slowing the process down.
Yeah, but properly functioning, you're right.
Properly functioning, yeah.
Yes. And the problem there is many of the securities were held by highly leveraged institutions that blew up. That was the problem. And our new capital requirements are providing even more incentives for our banks to become hedge funds and not lending institutions.
Thank you very much. I thought this was a terrific discussion. And we're on to the next panel.